All right, let's dive in today. We're looking at a really interesting Motley Fool piece. It's called Two Growth Stocks to Buy in the Tariff-Fueled Market Correction.
Okay.
Published pretty recently, April 10th, 2025.
Yeah, I saw that one.
It focuses on two companies, Alphabet,
Right.
the parent company of Google,
Uh-huh.
and then DexCom.
It's interesting.
So in this deep dive, we're going to try to break down why the Motley Fool thinks that these two companies are worth looking at.
Especially now, right?
Exactly, especially now, given that we've got these new tariffs and how they might
How they play into it.
play into the investment thesis for both.
What are the headwinds and what are the tailwinds?
Yeah, are these tariffs going to present challenges?
For sure.
Or are they going to be something that actually ends up being beneficial?
Opportunities.
Opportunities, exactly.
Right.
So I think, the big question that we want to start with is how can tariffs, which, a lot of times we hear about as being negative for the economy,
Right.
how can they actually create opportunities?
Yeah.
Especially for growth-oriented businesses.
That's the question, right?
Exactly.
How can something that seems negative on the surface actually create these little pockets of advantage?
Okay, so let's start with Alphabet.
Okay, so the article kind of jumps right into it. And it says, there's a potential near-term problem with Alphabet when it comes to tariffs. And that is that these tariffs could actually push us toward an economic slowdown.
Okay. Yeah.
Potentially even like a recession.
The recession vein.
And, when times get tough for companies, what's one of the first things they look at? Costs. Yeah, what can we cut?
What can we cut?
And often that's...
Advertising budgets.
And a lot of Alphabet's revenue
Right.
comes from advertising.
Right. So Google search, YouTube.
Yeah.
These are big, big revenue drivers for them. And they're based on advertising.
So if companies start pulling back on ad spending, that's going to directly hit Alphabet's bottom line.
Right. So the Motley Fool's thesis is that we could see some headwinds for Alphabet.
In the short term, right?
In the short term. But
Right.
in the longer term, they seem to be pretty bullish on it.
Yeah, there's a lot of optimism for Alphabet over the longer term. And that's based on a few key strengths that they have.
Okay.
So first and foremost is their dominance in online search.
Even though we've got all this talk,
Hype.
all this hype about AI and these new AI search tools.
Search tools.
People are still using Google.
Yeah, and I think it's interesting that they're not just, sitting back.
Resting on their laurels.
They're not resting on their laurels.
They're incorporating AI.
Yeah, they're incorporating AI into their search.
Yeah, it's smart.
Like,
They're not afraid of it.
They're not afraid of it.
You're embracing it.
AI overview.
Right. That seems like a smart move.
They're staying ahead of the curve.
Stay ahead of the curve.
Leverage the new technology as opposed to being scared of it.
Yeah.
So that's their first strength, right?
Yeah.
The second strength the article points out is the significant growth
Okay.
they're seeing in their cloud computing division and all these AI initiatives that they've got going on.
It's not just experimental.
These aren't just little side projects. This is a big part of their business.
It's becoming more and more important to their overall revenue.
Absolutely.
We also can't forget about YouTube.
YouTube, yeah.
It's not just user-generated content.
It's massive.
It's massive.
It's so much more than that.
It's a huge platform for
all sorts of video.
All sorts of video consumption.
And it's a huge revenue generator for them through advertising and those subscriptions.
Yeah.
I mean, the article even mentions that their combined cloud and video streaming businesses had an annual run rate of $110 billion.
Wow.
By the end of 2024.
That's a big number.
And it actually exceeded their own projections from the beginning of the year.
So, what I'm seeing here is that they've got
scale.
They've got scale.
And they've got diversification.
Diversification of income.
Lots of different ways to make money.
And that's important.
Yeah, if one area takes a hit, they've got others to fall back on.
They've got others to fall back on.
It's a buffer.
So you can't talk about Alphabet without mentioning this.
What do they call it?
Their moat.
Their moat?
This idea of a competitive advantage.
That's hard to overcome.
Hard to overcome.
Like a castle with a big moat around it.
Yeah, exactly.
Hard to attack.
And what creates that moat?
So for Alphabet, it's the network effects of their search engine and YouTube. The more people use them, the more valuable they become.
Right.
And then, of course, their brand.
Brand recognition.
Everyone knows Google.
Yeah, everybody uses Google.
It's a verb.
It's a verb.
So even if, their stock price takes a hit in the short term, Because of the tariffs.
The economy.
The economy. Their core business
is still super strong.
It's super strong.
And those competitive advantages, they're not going anywhere.
They're not going anywhere.
So for patient investors,
yeah,
especially those with like a 5-year
or longer
outlook, the article seems to think this could be
a buying opportunity.
A really good time to buy.
Yeah.
While the price is maybe a little lower.
A little lower than usual.
Okay, so that's Alphabet.
Okay, that was a lot on Alphabet.
It is. It's a big company.
It is a big company.
Lots going on.
Let's switch gears.
Okay.
To DexCom.
DexCom. Now they're in the medical device industry.
Mm-hmm.
Specifically, continuous glucose monitoring.
CGM.
CGM, exactly.
Important for folks managing diabetes.
Yeah. No more finger pricking.
You can track your glucose levels.
Real time.
In real time.
Okay.
Now with DexCom, tariffs might affect them a little differently than Alphabet.
Okay, how so?
Well, it's not so much about people suddenly not needing their product.
Okay.
It's more about their costs going up.
Okay.
Because they manufacture globally.
Right, they've got those newer facilities.
Ireland, Malaysia.
Yeah.
So these tariffs could mean higher costs for the parts they import or the finished products they're shipping around the world.
Which could squeeze their profit margins.
Yeah, in the near term.
In the near term.
That's the concern.
Okay, but they also have manufacturing in the U.S., right?
Right, and it's significant.
28%.
28% of their revenue in 2024 came from the U.S.
Came from the U.S.
Where they also have manufacturing.
So maybe that could help.
It could offset some of those cost increases.
Yeah, a little bit of a cushion.
A little cushion, exactly.
So even though they might see some cost challenges, people still need their products.
Right. That need isn't going away.
It's a vital product.
Exactly.
And the Motley Fool seems to think that their long-term growth is
strong.
Looking pretty good.
So first, more and more insurance companies and payers are covering CGM devices.
Okay.
So that means more people have access.
Right.
The article even quotes DexCom's CEO, Kevin Sayer. He said that reimbursement for CGM has expanded significantly.
Like in the past couple of years?
In the last 2 years.
And that's good news.
That's huge.
Because more coverage means...
more potential customers?
Yeah.
And even within the folks who are already covered, there's still a big untapped market for CGM.
So there's room to grow.
Oh, yeah.
Domestically.
For sure.
And then globally, I mean...
globally, it's even bigger.
Massive.
They quote Abbott Laboratories in this article. And Abbott estimates that only about 1% of adults with diabetes
worldwide
have
access to CGM.
So DexCom isn't everywhere yet.
Right.
But that just shows you how much potential there is.
Yeah, huge potential.
It's a vast market.
Very low penetration.
And then, just like Alphabet, DexCom also has that network effect.
Oh, interesting.
How does that work for them?
Yeah, how does that work for them?
So as more people use their CGM systems, it encourages other companies to make products that work with DexCom's technology.
Right, like insulin pens or pumps.
Exactly. They can integrate with the data from DexCom sensors.
Yeah, it's like an ecosystem.
And all connected.
The more connected it is, the better the experience for the users.
And the harder it is for them to switch to a competitor.
Yeah. So even though there might be these short-term cost increases from tariffs, the big picture for DexCom
is all about growth.
It's all about growth.
They're expecting to stay a leader
in
the CGM market.
And just deliver strong
revenue and earnings.
Revenue and earnings growth long term.
That's the thesis.
So we've got these two very different companies.
Yeah, one's a tech giant.
Tech giant.
The other is a medical device innovator.
But both of them
could benefit from
a market downturn,
which might be fueled by these tariffs.
Yeah, it's like this counterintuitive
it's interesting.
kind of idea that sometimes bad news
creates opportunities.
Creates opportunities for some companies.
Exactly. If you can look past the immediate
noise,
the headlines.
And focus on those strong fundamentals.
Yeah, companies with strong market positions, growth drivers, competitive advantages.
Like these moats.
The moats, exactly.
Sometimes that uncertainty can create buying opportunities.
Yeah, like a dip in the stock price.
A dip.
That's a chance to get in.
So thinking about this
I know.
Makes me wonder what other sectors
or types of companies
might be similar.
Yeah, where the tariffs might actually help them in the long run.
Right. And what are the factors that we need to look for?
What are the signals?
to identify those opportunities.
It's like a treasure hunt.
It is a bit of a treasure hunt.
But it's exciting.
It is exciting.
It gives you something to think about when you're looking at the markets.
Absolutely.
So just a reminder.
Yes.
This deep dive was based on the Motley Fool article.
2 growth stocks to buy in the tariff-fueled market correction. We hope that this breakdown has been useful for you.
Yeah, hopefully it's a good starting point.
A good jumping off point.
To get you thinking.
We always encourage you to read the full article.
Do your own research.
Do your own research.
Make informed decisions.
Informed decisions.
That's what it's all about.
Absolutely.
Thanks for listening.
Thanks for joining us for this deep dive.
We'll see you next time.
We'll see you next time.